With concerns about the U.S. debt burden on the rise, today's lesser known bond auctions are gaining significant attention as indicators of demand for U.S. debt. In a key event today, the U.S. Treasury auctioned off $22 billion in 30-year bonds, and producer price index data was released this morning, showing the state of inflation amid trade tensions. So, building on the video from yesterday, where we described a auction and how these work, here are the results for the 30-year auction. I'll briefly recap how these auctions work. It's what is known as a Dutch auction. A seller, in this case the Treasury, sets the price. That price for a Treasury auction is called the when issued. This is a market determined rate at the time of the auction. The auction begins, goes down in price until all of the units being auctioned off, in this case 30-year treasuries, are sold. Whatever the clearing price, whatever price is necessary to get all those units sold, that is what the auction clears at, and that is what everyone gets offered. So here's an example that I updated from yesterday with an additional concept here. So a couple of people asked, what about this last number, the awarded at high? So the reason I didn't go over this yesterday is it's kind of confusing. Remember, with a bond, the yield is inverse to the value of the bond. So in this case, this is an example of a strong auction. You have 100 units, product XYZ. The price goes to 90. You can see there's someone waiting for 80 units bidding there at 90. That would represent a lower yield, right, than $80, where bidder B and C are. This is a higher yield because remember, they're inverse. So as the value of the thing goes down, the yield would go up. This is how a treasury auction works. So what awarded at high represents is the share of bids that are awarded at the high yield. You could also think of this as awarded at the low price. And so clearly a lower number here is stronger. You can see here, not only is the bid to cover 1.0, meaning there's only 100 bids and they're trying to sell 100 units, whereas over here there are 300 bids and they're only trying to sell 100. This is oversubscribed. This is just barely fully subscribed. You can see the awarded at high over here. 40% of the bids are down here at the low price, at the lowest price, or put another way, at the highest yield. So I did update this example with that, the awarded at high. Hopefully that makes sense. The lower this number is, generally speaking, the stronger demand, because this is telling you, it doesn't take a huge drop in price or huge rise in yield to get everyone to bid. Right over here, the price had to drop significantly to get the auction to clear. And 40%, almost half of the bids in this total auction, almost half of them were at the high yield of 2.5%. Put another way, that's at the low price. So hopefully that concept makes sense. Remember, tail and stop through. A tail is what we see here. This is a large variance down in price or up in yield. A stop through is the exact opposite, which is actually, a very strong auction. You might have selling 100 units and their bids, people really want this product, and their bids up at 105, 110. That price is actually higher, and so the yield would be lower than the when issued, right? What they're trying to get. And so that would represent a stop through. It's the same exact concept. It's just that a tail represents variance downward in price or upward in yield, whereas a stop through indicates upward variance in price or downward variance in yield. Here's what the press release looks like. If you ever want to look at this stuff, it's on treasurydirect.gov. You can find all the auctions, what date and time and what is being auctioned off. You can find these press releases that go through all the information. Here's the result of yesterday's auction. So again, remember, stop through is bullish. This indicates that this is the 10-year auction yesterday. Stop through indicates that the price that was needed was actually higher than the when issued, and the variance was upward in price or downward in yield. It's very, very slight. It should be noted that it's only about 1 basis point. But still, the concept I think is important. And you can see that the past four auctions for the 10-year have had a stop through. This is bullish. Here is the composition of yesterday's auction. And again, remember black bid to cover. This is the total number of bids divided by the total units trying to be auctioned off. We can see yesterday's auction was relatively constant, 2.5. And then primary dealers, remember buyers of last resort, direct bidders. This is people bidding directly, hedge funds, pension funds, family offices. Indirect bidders, generally, this is large foreigners. Here's what the 30-year today looked like. So this one stopped through, unlike last month, where, like I mentioned, the 10-year has had a stop through the past 4 months. We can see that out of the past 4 months, the 30-year auctions, we've had two stop throughs, including this auction today. But we've also had two tails. So maybe you can draw from that slightly weaker demand for the 30-year. In any case, it did stop through. This is generally a strong indication of strong demand. Here in yellow, this again is just the yield that you can find anywhere. Red, in this case, represents that bid to cover. This is the total number of bids divided by the total auction size. We can see again that's relatively constant, around 2.5. Primary dealers in this case are blue at the top. You can see that those have been declining. That's good. Indirect bidders here, you can see in red, and they are relatively flat going back to 2015 or 2016. You can see, again, there's noise with some of this stuff, but it does appear like indirect bidders are slightly, the trend at least, is slightly weaker than the 10-year auction. Maybe that's just my eye seeing things. You can draw your own conclusions there. Here are the results of the auction. And we can see that the high yield, 4.84. The when issued yield, this is the price that they set the auction for, was actually higher at 4.859. This is the WI means when issued. This is a market determined rate that tells the Treasury basically what they're trying to start the auction at. And you can see that the 30-year when issued was 4.859, but in fact, the auction result was 4.84. So, ever so slightly lower. Again, this means a stop through because what this represents is a higher price than expected, a lower yield. You can see bid to cover was 2.43, very small percentage awarded at the high. Again, this is good. Primary dealers took up slightly more in today's 30-year auction than yesterday's 10-year auction. It was still a relatively low amount, and we can see, in the chart here, we can see that generally speaking, that primary dealer has been declining. The percent of the total auction that the primary dealer has to take, that has been declining, as we could see there. PPI data came out today. This is one measure of inflation, and this is called the Producer Price Index. We see here in white the year-over-year change, and then in yellow the month-over-month change. We'll go over the year-over-year first. This has been trending up, going all the way back to summer of 2023. We can see that that is when the Producer Price Index bottomed, was 2023, and it's been basically headed higher ever since. We can see that the headline number on a year-over-year basis is 2.6%. Now, that is actually down from January, from this current administration's kind of inauguration, and right when they first started talking about, oh, we're going to tariff and we're going to do all this kind of stuff. PPI back then was 3.6, 3.7, and we can see it's down almost 100 basis points, but it is part of this kind of bounce. It set a low here in the summer of 23 and has been headed higher ever since. If it can break below this kind of trend that it's in, that would be a good indication for most people. Here's a month-over-month basis here. And this shows the Producer Price Index, how much it is changing month over month. So we can see that since last month, the Producer Price Index is up 0.1%. Here I will put a line at 0 so you can see anytime this number is below 0, that indicates producers are actually paying lower prices than they had been the month before. We can see that it was definitely negative here in April, but is ticked up slightly. There's a ton of noise in these month-over-month data prints. So again, I keep saying anyone that tries to annualize out a month over month number. Be very, very skeptical of that. But another strong auction today with the 30-year, strong auction yesterday with the 10-year. Hopefully, the updated example helps illustrate that point about the awarded at high. It is an important metric for sure. I just didn't want to confuse people because the yield actually goes up as the price goes down, and thought that might be confusing for people. But anyways, hopefully that was helpful, and I will catch you in the next one.